Amazon stock reported their Q1 earnings after the bell today. During the regular trade, shares of Amazon up nearly 4.6% to finish the day close to $110 per share. After announcing those Q1 results, we are seeing shares bounce around a little bit, but they're up another 7% to bring Amazon stock close to $118 per share. We'll talk about what this means from a technical perspective. I'll walk you through the complete financial document at Amazon. This is probably one of the most complex and most misunderstood stocks, particularly in Major FANG, but also in the technology sector and the broader stock market in general. We'll talk about all of the things going on from a cash flow, a balance sheet, from a different sector and business unit perspective when it comes to Amazon. Now, we've got to get into these Q1 numbers. Revenue coming in at $127.4 billion. That was 9.5% growth. Folks, let's not just brush over this. $127 billion in revenue. We're not talking about over the last 12 months. We're not talking about over the last 12 years. We're talking about in 3 months, this company generated over $127 billion of revenue, and that was up 9.5% year over year. It beat expectations by about $2.8 billion. Now, they beat on the earnings side, but we'll get into the nuances of that in a second. More importantly, though, we got second quarter guidance from Amazon as well. Net sales coming between $127 billion all the way up to $133 billion. So we are going to see likely some gains sequentially. Now, you might be wondering, what was Wall Street's expectations for the upcoming quarter when it came to revenue? $130.34 billion was the midpoint, which means if Amazon can come towards the high end of the range, they will be beating the midpoint. When you look at the broader range of 35 analysts covering Amazon, the broader range, again, this is for the upcoming Q2 revenue, the guidance was between 128 to 133, so a little bit light on the low end. If Amazon somehow comes in at 127, that will absolutely be a disappointment, but the high end of 133 was right where the high-end analyst was. Now, that's what makes this quarter particularly impressive. We're back to Q1. The $127.4 billion worth of revenue was above the high-end estimate. Now, some of you guys are going to say out there, well, this is the game Wall Street analysts play. First of all, these earnings estimates 6 months ago, 12 months ago were certainly higher. And yes, you're absolutely right. Wall Street plays games, and you as an investor pretty much has to go along for the ride and play the game with them. But when 38 analysts have estimates when it comes to revenue, and Amazon comes over the high-end estimate at 126 and they deliver 127 and change, that is a good sign. And when the Q2 backs up what they have projected for Q2 as well, about 7.5% growth, that is a good sign. Now, obviously, if we start looking back into the back half of this year, potentially we could be going back to double-digit growth. And some of you are like, well, double-digit growth over at Amazon. Well, yeah, we're talking about double-digit growth on $130 to $160 billion worth of revenue. It's not easy to grow your business double digits. It's even harder when we're talking about this much revenue. And so, yes, some of you guys are going to point out, well, yeah, you got a 72 forward priced earnings. When we get into cash flows, we'll get into operating income in a minute. Yeah, the company isn't doing great from a profit perspective, but you've got all this revenue to play with. And if you drive efficiencies in the future, when it comes to robotics, when it comes to artificial intelligence, when it comes to replacing some of these warehouse workers, even a small percentage of it, that is where your earnings and your reward at some point with Amazon is coming. Now, the company kicks things off with a cash flow statement. I don't like to kick things off with a cash flow. I like to show you operating profits first. We'll back into cash flows here in a moment. We have our 3 months ended since this was a Q1 for Amazon. Our right-hand column is our most recent quarter total net sales coming in that aforementioned $127.4 billion. Again, that was 9.5% revenue growth over $116 billion a year ago. These are just gigantic numbers when we talking about from a net sale, raw net sales perspective when it comes to Amazon. Now, what I've noticed, okay, this company has been in cost-cutting mode, but not a lot of that that, again, this is for 3 months through March, not a lot of those efficiencies have really flown through because you still got to pay some of these people. There's still severance costs. You're probably still paying some benefits, okay, for a period of time. You're probably not going to see the read-through, especially on the white-collar worker. You're not going to see those cost cuts come until maybe Q2, but definitely Q3 and Q4. But what I'm seeing from an operating perspective at Amazon, very, very impressive given the 9% revenue growth. Look at your total cost of sales from 66.5. Again, you would expect these to go up. Your sales went up 9%. Your cost of sales are going to go up as well, but not much, from 66.5 up to 67.8. Now, your fulfillment cost, those didn't really go up that much as well, from 20.3 up to nearly $21 billion. Here's where the company is making a lot of investments is in technology and content, certainly on the streaming side, certainly on the MGM studio side. They're making a lot of investments there from 14.8 all the way up to 20.5. I would expect this cycle, well, first of all, it's going to continue, but probably the degree of growth. I mean, this is like over $6 billion worth of growth. What's that, like 40% off the top of my head? I can't really do the math, but that's like 40% growth on that technology and content. Obviously, that is going to continue to go, but I would imagine at some point that kind of starts to equalize. Here's your sales and marketing from 8.3 up to 10.1. Not bad. Your general administrative from 2.6 up to 3. Overall, we bolted on, we'll call that about $11 billion to the top line, and we bolted on just south of about $10 billion to your operating expense line. So that means your operating income is going to trend in the right direction from $3.7 billion last year all the way up to close to $4.8 billion. Now, as an investor, I would encourage you to stop right here on 99.9999% of your companies. Look at sales, look at operating expenses, and you focus on operating income. Because after that, you get to some interest income, which is rather favorable at the moment, considering where interest rates are, your interest expense. You see this company is running at very close to a net debt perspective that is equalized. But with Amazon, they have this other income or expense line. Last year was $8.6 billion. This is due to their investment in Rivion, which has absolutely tanked over the last year. But over the last 3 months, the stock is kind of, a story is kind of played out with that. And so they don't recognize as big of a loss, unrealized loss on that type of investment. So when you start comparing net income, EPS over at Amazon, it looks really, really good. And that is largely because they had to take a $8.6 billion charge to that Rivion investment. Again, that's an unrealized gain. So I would just focus right here on operating income and just notice that, yes, this company has passed through some cost cuts already that are likely showing up in this Q1, but there's probably even more coming in Q2 and even more in Q3 and Q4. And you couple that with the fact that you have this guidance that is at the very least going to meet Wall Street estimates, then things are probably going to get even better for Amazon. This is why the stock was up initially 4.5% today, and then we're seeing a follow through of about 7.5% in the after hours. Let's come over to cash flows. That is the first thing Amazon is going to want to show you. They do show you they have $52.3 billion worth of cash and cash equivalents. That's up from $36 billion, primarily due to some borrowings. You pull down that net income loss here on cash flows. So last year we talked about how it was 3.84, but they get to add back in that other expense or an income. In this case, this is the Rivion investment. You get to add things back in, like share-based compensation. You get to add back in depreciation and amortization, which on some companies isn't very big. On Amazon, it's gigantic, okay? They've got all these warehouses and all these property, plant, and equipment. These things depreciate over time. They recognize that as a cash charge down here, but it's not actually cash flowing out of the business. This is why the company leads with a cash flow statement, because you pull this net income number down of $3.2 billion. You get to add back in non-cash depreciation of 11.1. You get to add back in $4.8 billion worth of stock-based compensation, which I really don't think these companies should be allowed to do. But look, accounting rules get to do that. And in this quarter, the Rivion stake didn't really impact earnings quite as much. It's actually right there. But you might want to factor that in when you compare to last year, where you had operating cash flows at Amazon on a quarterly basis turn negative $2.8 billion. This year, it turned positive to $4.8 billion, again, on higher revenues, better cost controls, less of a Rivion investment, higher depreciation add backs, looking very strong. The other thing that you want to look at when you look at the cash flow statement at Amazon is this purchase of property, plant, and equipment. And you want to kind of see what kind of run rate they're on. And what I'm seeing quarter over quarter, we're starting to flatten out a little bit at about 14 and some change. Again, this is $14 billion worth of property, plant, and equipment. You look over the last 12 months, this company has spent nearly $63 billion on property, plant, and equipment. You come down here to the financing activities and you see where we talked about how their cash really accelerated from 36 billion up to 54. Some of you guys are going to be scratching your head saying, well, they did $4.8 billion in operating cash flow and then they spent another 14.2 on property, plant, and equipment. So where'd this cash come from? You come down here to the financing activities. That's where you get your answer. So you have your proceeds from short-term debt, about $12.8 billion. You paid about 3.6 of that. So you netted about $6 billion from the financing side. They didn't buy back any shares in the most recent quarter. So I thought that was interesting. Last year, they bought back about $2.7 billion in shares. This year, they decided not to buy back any shares in the most recent quarter. Now, we'll just skip the balance sheet with Amazon, or it'll likely come up after we look at the different operating segments when it comes to Amazon. This is very important. There's about two more things. So hang with me during this financial document. You are going to get some very valuable nuggets when it comes to analyzing Amazon. We've got our 3 months ended here. Right-hand column is 2023. Here's your North American business. If you remember our last couple of videos that we've done on Amazon, we've been disappointed with this company. And the fact that they are not making money, at least from an operating profit standpoint, here in North America with their e-commerce business. Well, look at this. $69 billion worth of net sales this year, all the way up to very close to $77 billion worth of net sales. And your operating expenses, while yes, they did climb from 70.1, or we'll call that 71, up to about 76 billion, we did churn out the smallest of operating profits on $76 billion worth of revenue. We churned out, we'll call that $890 million worth of operating profits. Now, the next thing that we've got to do over at Amazon is turn this international business into a profit. It is not there yet, and you are seeing net sales in the international e-commerce business start to stall, which is not a good sign, from 28 billion up to just fractionally to 29.1. They need to do more controlling the cost in their international business over at Amazon, because you see your operating loss year over year essentially the same, from 1.3 billion up to, we'll just call that $1.3 billion. So the company is making a little bit of money here in North America, but it all gets chewed away in the international business. Now, if you're going to start poking holes in Amazon, the AWS business, and I'm actually surprised a little bit that the stock is reacting this well in the after hours. Investors must have really had thrown out maybe Q2 guidance, and maybe they've really thrown out this e-commerce business, because look at the AWS business. I will show you here in a moment the growth rate. I'm not a human calculator. I can't tell you from 18.4 billion up to 21.4 billion. Some of you can do that math in your head. I can't, but I'll show you that growth rate is a disappointment, especially when we compare it to Azure's growth rate, which we saw yesterday from Microsoft, and Google's. Maybe it's the day before. But Azure and Google growing much faster from a net sales perspective than AWS. The other thing that's a problem with AWS is look at your operating expenses. They went from 11.9 all the way up to $16.2 billion. So despite higher net sales in the AWS, again, the cloud computing business, at Amazon, you went from $6.5 billion in operating income down over $1.4 billion, or about $1.4 billion. You're down to 5.1. So increasing revenues, but increasing operating expenses there. My guess is on the read-through, I'm absolutely certain somebody will ask this on the conference call, and if you're an investor that dig through these, I would see if they're trying to capture market share here, or if maybe they had some one-time costs that are flowing through here, but this is a disappointment, both on the growth side and, in my opinion, probably the profit side. Here's the aforementioned balance sheet with Amazon. Not a ton to see here. Inventory looking flat, at least from the beginning of the year to now. That's probably a decent sign. Long-term debt up just fractionally as well. Now, the last thing, probably easily the most important thing when it comes to Amazon, is a slide nearly all the way to the bottom of the financial documents. I tell you what, when you look at enough financial documents, you'll know that towards the bottom are where all the Easter eggs are hidden. And here on Amazon, they show you your online stores business. This is your e-commerce business, $51 billion worth of revenue. That represented 3% growth ex constant currency. So I'll just give you all these results in a constant currency. You will see here year over year if you want to factor in the fluctuations of the United States dollar versus the currencies Amazon is collecting these. Obviously, a weaker dollar, this goes without saying, but a weaker dollar, if the dollar index can continue to weaken against the broader developed market currencies, the euro, the yen, that is very bullish for not only Amazon, but pretty much all of mega cap tech and any multinational company, including companies like Pepsi and Coca-Cola as well. Now, your physical stores, this is broadly Whole Foods. That was up 7% in the most recent quarter. That was about $4.9 billion business. Here are your third-party sellers. So what a lot of people don't realize with Amazon is a lot of the time you're actually buying from a individual seller. That was up a somewhat disappointing 20%, although we see over the last couple of quarters we're up 20%. And again, the rule of 72, you take 72 divided by a number like 20, they are doubling this business every 3.5 years. So this number at 29 billion, if you can average a 20% growth rate, means we'll be at 60 billion in just 3.5 years on that. Your subscription services, this is Prime and the other subscription services, very healthy 17%. What I'm noticing here is we're maintaining a very healthy growth rate in the Prime business, and you can imagine the gross margins on this subscription business. Okay, for somebody to subscribe to Prime is probably a relatively high margin business. Your advertising business should be some excitement here. 23% growth, matching last quarter's growth rate here. Again, this is a business. If you can maintain 20% growth rate, you are going to double this business in 3.5 years. Means you're going to have a $20 billion per quarter advertising business over at Amazon. Your AWS business, what we talked about a moment ago, the lowest growth rate on record over the past 4 quarters, 16%. It was 20%, and that is down from kind of a mid-20s, even as high as 30 and 40%. So investors are going to want to have answers on AWS. Can we re-accelerate this, or we have essentially topped out in that kind of mid-20s growth rate or mid-20s revenue number that we're seeing with AWS? And finally, you have other over at Amazon, which has grown exponentially over the past couple of quarters. In fact, you had triple-digit growth rate. That was followed by 57% growth. They lumped MGM Studios revenue into other. So this is your movies and some of your other content in here. My guess is Amazon is either going to voluntarily break that out at some point, or the SEC is going to require them to break this out. But it's still only, I say only, $1 billion business on a quarterly basis. My guess is it's got to get a little bit bigger than that for the SEC to come knocking and say, you need to provide more clarity on that. Now, when we come over here and look at it from a technical perspective, this stock is popping in the after hours, up here at about where this green bar is, to about $117 per share. That's another 7% to go on to a 4.5% gain during the regular trade. Amazon was in a green box of consolidation, telegraphed very easily. The reason why we really like this stock is it is now currently making lower highs. If we can close at this green candle, why don't we just turn this into a green candle that could show up tomorrow? Whether or not this thing goes up to 115, 117, or maybe kind of peters out, wouldn't surprise me if this stock gets digested a little bit and we really only go up to 115 or so. That's still good enough, confirming higher highs on this one. And you really don't get to any serious overhead resistance with Amazon until you get to about 140 per share. That's why this stock was exciting south of 100, because just a retracement back to overhead resistance was at bare minimum a 40% gain in this stock. Right now, we'll find out how Amazon reacts tomorrow. I would assume any close above about 113, 114 is a positive sign for this stock. We'll obviously be back tomorrow on Friday to recap it for you all on the Fang Stock Recap Show. That was our Amazon Q1 earnings. If you took a chance on this one and you bought it south of 100, which is probably not a ton of people, but if you did, it was well telegraphed, well planned, well executed, and in the after hours, you are being rewarded by taking that risk. Shares of Amazon up to $118 per share as we speak. Hopefully, you guys have a wonderful day out there. We'll see you again tomorrow for the FANG Stock Recap Show. Good luck with your investments.